Good morning. It's Mike Lynch with AmeriFirst Financial, and it's time for your Monday morning mortgage update for the week of April the 18th, 2022. So it's tax day today. IRS didn't require us to turn taxes in on Friday because it was Good Friday, Easter weekend. So hopefully y'all spent the weekend not doing your taxes, but enjoying time with family on Easter. I smoked my first Easter ham. Can't believe it's taken this long for me to do it. Turned out fantastic. So we're going to talk about what happened last week and what's going to happen this week. Last week, the mortgage-backed securities market was down 58 basis points. So we know that when the market's down on the bond side, people put their money in one of two places, the riskier stock market or the safer bond market. When money flows into that bond market, which is where mortgage rates are determined, then rates go down. When money flows out, rates go up. So there was a 58 basis point sell-off, which means money flowed out of the bond market and mortgage rates went up. Now, hey, the good news is it wasn't as bad as the week before where there was over 100 basis point sell-off. But, I'm a broken record here. We're just getting sell-off after sell-off after sell-off, and rates are going up and up and up. And it's really important that we respond to our clients and be proactive when we're meeting with them, our buyers and our sellers, to put the elephant in the room. Everybody's talking about it. And the more information you have on why this is happening, what the future is going to look like, the more trust that buyer and seller has in you, because we have to be the interpreter of the information. We're not the information. They're getting this from every news source, every website, every blog, every opinion on TikTok, whatever it is. And so we have to really take the information we know they're getting and put it into perspective. So let's try to do that a little bit. What happened last week is those rates went up. And what's going to happen this week? Three things. I always try to focus on those three things. The Federal Reserve, they're going to be talking this week, and we want to focus on some important information from that. Economic reports that could possibly move the market. And then, are we at a market peak? Are home prices at the top? Are they going to slide? So let's talk about the Fed first. The Federal Reserve raises and lowers that prime lending rate, or the Fed rate, whenever they think they need to do it. And they manage fiscal policy, obviously, in this country. And so we know 3 weeks ago, the Fed raised the Fed fund rate 0.25%. They haven't raised it in 2 years. And they raised it because they've got to fight inflation. Inflation is up. We know that. Last week, inflationary numbers were record highs again, which is bad for mortgage rates. And so if the Fed raises that fund rate, which they have to do, that slows down spending. It slows the economy down, and that's going to curb inflation. And so the Fed basically said last week they're probably going to raise this 6 more times. We have 6 meetings the rest of the year, and they're going to raise it all 6 meetings. They raised it 0.25% 3 weeks ago. So are they going to raise it 0.5 point in the coming meetings? There's some expectations that they're going to raise it up to 3.5%. Remember, it's been at 0. Raise it up to 3.5% by the end of the year. That's going to have a big impact on spending, because remember, that Fed fund rate that we all hear about in the news, it doesn't affect mortgage rates. It affects home equity line rates. It affects auto loan rates, credit card rates, but it also affects the interest rates that businesses pay to borrow money. And businesses need money to operate and to grow. And if it's costing them more to borrow money, that's going to slow growth. That's going to slow production because they're going to pass that savings on to everybody else, or that cost, if you will, onto everybody else. And people are going to buy less. They're going to spend less. It's just what's going to happen. And the Fed accelerating this increase in the Fed rate is going to drive us into a recession. It's coming. We've already seen signs that it's coming. And so they're going to talk this week about really what is the speculation on how aggressive they're going to get in raising this rate. The second thing the Fed's probably going to talk about, the Fed members in interviews and discussions they have, is the balance sheet. So we know that the Fed stopped putting money into the bond market in March, and that means that a lot less money is flowing into the bond market, and that drove rates up. And so now they're talking about putting less money in the back end of the market called reinvesting. And that's basically tightening, what we call tightening their balance sheet. And so we're going to get some indications on how aggressive they're going to get on that as well. And so they stopped putting money on the front end. Now, if they stop putting money on the back end, we're going to see rates go up again. And obviously, this is going to have a big impact on our buyers and sellers and what they do and what they decide not to do. So we'll pay a lot of attention to this. Is this back end tightening going to happen in May and June? What are they going to do at the next Fed meeting? How much are they going to raise those rates? A lot of things might come out this week. Second thing is economic reports. A lot of housing data this week. Nothing really is going to affect the market. We got housing starts, permits, existing home sales, Thursday weekless jobless claims. Again, a lot of stuff that probably won't move the market that much. And then market peak. I get a lot of questions from buyers, sellers, agents. Are we at the peak of the market? Well, let's be honest. We have a little bit of PTSD from the last housing crisis, right? We think if prices are going to go up this much, and they've gone up, as we know, significantly, we got to fall off a cliff like we did last time. And I think we can probably all agree, if you really look at the details of the difference between then, back in 2008, 9, and 10, and now, there's a lot of differences in the market, in supply and demand, and the demographics, in the type of loans people have, and the equity people have in their homes, a lot of different things. So we're not going to fall off a cliff. Nobody expects us to, but rates are up. And that is going to have and is having an impact on what people are going to pay on homes. And is it going to change the sales price? And are we going to see a slowdown? Well, we already are seeing one. I mean, mortgage applications are down 20 to 30% since the beginning of the year. Now, a lot of that has to do with refinance business, but there definitely is a reduction in mortgage applications. And a lot of big banks are laying off people in the mortgage industry, a lot of layoffs, because they expect a slowdown in the market. But here's another statistic. Of all the homes that have been sold this year, 70% of them are still bid over asking price. People are still paying more than the list price to buy the home. So that shows you there is demand out there. And you talk to a lot of people, they're not seeing a real big fall off in demand, even though rates are over 5% now on a 30-year fixed. Freddie Mac came out with a report last week that we need 3.8 million units underbuilt. We are underbuilt by 3.8 million homes nationwide. Now, if you believe that number, 3.8 is just to meet the current demand. It doesn't put into consideration what we need to do to get back to a normal market. And that's over 5 million homes. And this is just not going to cure itself overnight. There's some estimates that we need to be in a 10-year normal building pattern just to get back to normal inventory levels. So yes, demand is slowed, is slowed, but it's not significant yet. If you talk to people, we really haven't seen a big demand slowdown. So time will tell, and some information will come out this week that may give us some insight on what's going to happen in the future. So light economic week as far as reports, but still a lot of volatility. We're in a locking position. We're really not changing that, not playing the market. If you know somebody that needs some advice on locking their loan, please give me a call. If you have any comments, I'd love to hear them. If you know somebody that could benefit from this video, please forward it to them. Have a fantastic, productive week, and we'll talk to you soon. Bye-bye.